Hello, I'm Glyn Meredith and I work with Emblation in arranging finance for their business customers. So a clinic wishes to purchase Swift, what finance options are available to them? So there are effectively two main facilities. Number one being leasing and two, lease purchase or hire purchase agreement. So firstly, if we address lease agreements, they're a very popular facility for arranging medical equipment. Lease terms are generally from 2 to 5 years. The majority of customers tend to opt for 3 to 5. The equipment is financed on a monthly payment, and that payment attracts VAT at the prevailing rate and is payable with each payment. At the end of the agreement, although the customer does not technically own the equipment, there are established procedures in place that allow the customer to retain the equipment, normally by paying a one-off in perpetuity payment. So secondly, lease purchase or hire purchase agreements. They are similar in the sense that the equipment is financed over an agreed period of time, namely 2 to 5 years. Where it differs is that ultimate ownership of the actual equipment is stated from the outset. On the basis that the agreement is fulfilled in full, all payments made, there is a title fee that is indicated on the HP agreement, and that is payable with the last payment. The second aspect is VAT. VAT is normally due in full on a HP agreement from the outset. Although some, not all, funders can actually provide agreements where the VAT is financed over the course of the agreement and the relevant payments. This tends very much though to be for qualified medical customers and is of course subject to underwriting approval. So, is there any difference if it's a limited company or it's a sole trader? Generally, there is no underwriting differentiation between whether a business is limited or whether it is a sole trader or partnership. However, quite importantly, there are differences in the documentation that is provided and the different regulatory provisions and protections that apply to limited companies and unlimited sole traders and partnerships. A qualified podiatrist with HCPC registration can benefit from funding arrangements that recognise them as medical professionals. They therefore attract competitive rates. Where a clinic business is newly established, different underwriting criteria is applied, and alternative funders may be required to consider the specific client application. Interest rates may also vary as well with those alternative funders.